Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex. I'll start with Chicago soybeans themselves. The market continues to move higher, originally prompted by the combination of the springboard of the optimized February to October 2021 head and shoulders top neckline, currently at 1226, and the September to December 2021 lopsided diamond bottom pattern. These two, especially the lopsided diamond pattern, were an effective counter to the monthly key reversal down seen in November. Yet this bullish counter turned out to be so much more. The move higher from mid-December broke up over the resistance of the medium moving average, currently at 1304. Also the long moving average, currently 1357, and then the important 50% Fibonacci line of the December 2020 to May 2021 move at 1405, converting them all into supports. We did see some hesitation from the end of December last year until the middle of last week, but it was very much the case of two steps up and one step down during that time, forming a small bull channel in the process, which we broke up and out of last Friday. So where are we now? Well, last week I indicated one potential stopping off point on the upside at the 2014 high at 1522, which seemed reasonable at the time. But in reality, well, the market didn't even pause there in its rise. Prices moved straight through it, but have now slowed ahead of the next band of resistance between 1571 and 1578, which has the November 2012 high and the June 2021 high within. This would also tie in with a potential move higher from the recent bull channel, if we were to regard it as a possible bullish halfway hesitation, with the action actually from mid-December 2021 to date. I know it is not an ideal representation of a bullish halfway hesitation, but I can only work with what I am given. Where does that leave us with? What does that leave us with? Beyond the resistance between 1571 to 1578, we have congestion at 1615 and 1685, with a high at 2021 at 1667. However, there are additionally two trend lines that need to be considered. The first is the extension of the bearish bump and run reversal top trend line, currently at 1619 from March to June last year. This is not that strong a resistance, but it is worth noting. The second is a more heavy-duty piece of work. It is the neckline, currently also at 1615, of the big irregular head and shoulders top formed between 2010 and 2014. Its sheer multi-year size offsets to a great degree its age. Meanwhile, looking below, I've already listed earlier prior resistance that has become support. Well, to this I'll add, and also look as a first point of significant contact, the extension of the upper channel line, the broken channel line, of the halfway hesitation, and that's currently at 1465. Well, this now seems reasonable, right now. Chicago soybean meal. The key feature here for many weeks, and one that has been in effect since late November 2021, is the October to November 2021 bullish Andrews pitchfork. The upper time, currently at 463.40, had and has capped the market throughout, with the middle time currently at 437.90, acting as both support and resistance, and the lower time currently at 412.30, acting as support but getting broken last week and the week before. So why have I still kept it on the daily chart after its evident breaking? Well, just below the lower time, we have the 50% Fibonacci line for the whole of 2021 at 390.40. And it is this that has stopped a full exploitation of the break lower, and indeed turned the market back up within this now broken but still effective bullish Andrews pitchfork. The move up last week and this has also allowed me the opportunity to draw a fresh new bullish Andrews pitchfork for the late November 2021 to late January 2022 action, which is at a lower level but also at a slightly steeper angle of attack. So where are we now? Well, yesterday the market made an indecisive doji cross, right at the height of the recent market. Not a good sign if you were a bull out there. However, it is only one day. What is more interesting is that the market's run up this past week has been in a fairly clear zone of resistance. And it's only on Tuesday's close that we saw some signs of resistance. This was from a combination of the early April 2021 high, plus congestion highs from January and February 2021, all in the 433.5 area. Additionally, and this is perhaps equally if not more significant, the market hit the middle tines, currently at 437.80, of both of the previously mentioned bullish Andrews pitchforks. These middle tines have now formed a crossover today. And any of you who have read, listened, or seen my commentaries on time crossovers know that one could expect one or more of the following to happen: a change in trend, a reinforcement of an existing trend, and finally, just volatility. I'm wondering if the long-legged indecisive doji cross yesterday may be just the start. Now, one final thing. It is to look at action since late November last year as a possible pattern, a possible halfway hesitation. It is by no means a perfect pattern. However, the market has some pedigree in this, as it formed a similar, if smaller, pattern between mid-October and late December last year. If the market does indeed follow this path, then a potential topside target X would be in the 475 area. It is still early on in this idea, but it is worth considering. Chicago soybean oil. The recent major feature here is the mid-December to date bull channel, currently at 64.87 to 66.92. It's the narrower of the two, actually, if you look at the bull channels, the one within the other. The upper bull channel line was in operation by late December. However, the well-publicized by me anyhow, congestion between 57.65 to 59.45, dating from 2011 and 2012, well, that slowed and seemed to stop the rise in early January. All this was complicated and added to as well as resistance by the short medium moving average, currently at 58.44, the medium moving average currently 58.94, and the long moving average currently at 60.65. Eventually, it was only the move up over the long moving average made 2 weeks ago that wrenched the market away from the grip of this congestion and established a new, wider bull channel. Now, still utilizing the original upper bull channel line, but now with a new wider and lower bull channel line below. Since then, we've moved higher, initially within this wider bull channel, and then interestingly back within the narrower bull channel that's within this wider one. On the way up, we've pushed up over the October 2021 high at 64.30 and formed an indecisive doji cross on what I had last week termed as the next congestion in the 66.45 area. This ties in with the late July high from last year. I said last week that we have no other major patterns operational at this time apart from these two bull channels. Though I was, and I still am mindful that I could draw a bullish Andrews pitchfork and a bullish shift pitchfork for the December 2021 to January 2022 action. However, I choose not to, as this would be very narrow pitchforks and likely to be of limited use, perhaps only good for timing. And with nothing better actually to offer than what we already have with the two current bull channels. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes your final bit.